Who is minting money in the destruction of the US-Iran war? These five have struck silver. In the darkness of night, an oil tanker is standing in the middle of the sea. Its engine is on, the crew is alert, but the route ahead is no longer trustworthy. Ahead lies that same strait through which the world's energy pulse passes. And this time, the fear is not just of sea waves, but of missiles, mines, drones, and insurance costs as well. Somewhere, traders are watching oil futures jump on their screens. Somewhere, refinery executives are calculating emergency margins. Somewhere, defense boardrooms are drawing up new demand lists. And somewhere, investors are preparing to turn panic into profit. When war begins, the first thing that dies is trust. And when trust dies, money begins to flow for certain sectors. That is the most unsettling truth of this story. Where the fire of war burns, the heat of profit is often felt somewhere else. According to recent Reuters reporting, the US-Israeli war with Iran has now entered its third week. The Strait of Hormuz is badly disrupted. Brent has crossed $100 and its clear impact is now visible on global fuel prices. At the center of all this turmoil is the Strait of Hormuz. This is not an ordinary sea route, but the heartbeat of global oil trade. According to the latest assessment by the U.S. Energy Information Administration, about 20 million barrels per day of oil liquids passed through Hormuz in 2024, which was roughly 20% of the world's total petroleum liquids consumption and around 30% of global seaborne oil trade. Nearly one-fifth of the world's oil and a very large amount of LNG passed through this same choke point. When this corridor comes under the grip of fear, mining, attacks, or naval uncertainty, its impact does not remain limited to the Gulf. It creates a ripple effect across Asia, Europe, freight, refining, aviation, inflation, and currencies. Reuters also reported that after Iran laid mines and attacks increased, shipping nearly came to a standstill, and safe passage has now become the exception, not the norm. This is where the first major winner appears. Those oil exporters whose cargo does not depend on Hormuz, or who sit outside the Gulf disruption and take advantage of the world's desperate demand. When Middle East supply becomes uncertain, refiners begin searching for crude that can arrive through alternate routes. Reuters reported on the 6th of March that Russian Urals in the Indian market had, for the first time, started selling at a premium to Brent, because after the Gulf disruption, buyers shifted toward Russian barrels. Some cargoes at Indian ports were being quoted at a premium of $4 to $5 over Brent. According to another Reuters report from the 11th of March, the tax price of Russian oil also moved above Russia's budget target, giving the Kremlin's revenues a short-term boost. So this conflict did not just increase the oil price, it also increased the bargaining power of those suppliers who suddenly became the replacement barrel. Russia has emerged as the most dramatic example of this. The same Russian crude that had been forced to sell at a discount after the Ukraine war has now become an attractive fallback for buyers. The irony here is very deep. Because of Western sanctions, Russia had been selling at a discount for years, but the Hormuz crisis flipped the market math. Now, for refiners, the question is not whether the oil is politically comfortable or not. The question is where the oil will come from at all. That is why producers sitting outside the war zone, especially Russia, have suddenly moved into a stronger pricing position. Reuters reporting shows that the Asian demand shift made Russian exports more valuable. This advantage is not completely risk-free, because freight costs and sanctions-related issues still remain, but one thing is clear. The Gulf supply shock has given Moscow breathing space. Exporters like the United States, Canada, and Norway also appear to be benefiting from this equation. When both Asia and Europe start searching for alternative cargoes, the importance of Atlantic basin supplies rises. Reuters reported on the 4th of March that Asian refiners were looking toward Brazil, West Africa, and US cargoes because Middle East crude had become expensive, uncertain, and freight-heavy. This means war does not just destroy supply, it also rewrites the supply map. A barrel that was ordinary before becomes strategic in a crisis. And when any commodity becomes strategic, its pricing power rises. That is why, for oil producers sitting outside the conflict zone, this can become a windfall moment. The second major winner is refining hubs, and in some cases their gains come even faster than those of oil producers. When crude oil becomes expensive, the producer earns. But when there is a shortage of refined fuels, like diesel, jet fuel, and gas oil, refinery margins can explode. Reuters reported on the 5th of March that Asian refining margins had reached nearly the highest level in 4 years, and Singapore's complex refining margin had climbed to around $30 per barrel. Jet fuel margins had gone above $52 per barrel, and gas oil cracks had also touched around $48. This directly means that sophisticated refineries that convert crude into high-value fuels can see extraordinary economics at such a time. Refining ecosystems like Singapore, India, and the US Gulf Coast are especially connected to this disruption. Singapore is a global refining and trading hub, so when regional imbalances appear, margins show up there first. Some Indian refineries have historically benefited from discounted crude sourcing and export opportunities, especially when fuel markets in Europe and Asia tighten. The complex refineries of the US Gulf Coast are capable of converting heavy crude into high-value fuels, so their commercial value rises during global product shortages. Yes, if the war stretches on for too long, crude sourcing itself can become a problem. And Reuters also reported that some Asian refiners were forced to cut runs. But in the short term, product scarcity pushes refining economics into boom mode. That is the power of the crack spread. The wider the gap between crude and refined product, the faster the refinery earns. The third major beneficiary is the defense and security complex. When geopolitical tension turns into war, governments do not just issue statements, they increase procurement, speed up weapons production, order more surveillance systems, replenish missile stocks, and put pressure on contractors for faster delivery. Reuters reported on the 6th of March that the Trump administration pushed defense firms to boost production and that the Pentagon may be looking at a supplemental budget of around $50 billion. That means demand pipelines could become longer for missiles, communications, drones, counter-US systems, avionics, intelligence systems, and similar areas. War is not fought only on the battlefield. A large part of it is also fought in factories, contract desks, and supply chains. The market has recognized this pattern too. Reuters had earlier reported in January on the rally in global defense stocks, and in the 2026 conflict period, specific contract announcements have also increased. According to current reporting by Investors.com, Anduril received a $20 billion enterprise contract from the U.S. Army, while Boeing, RTX, and Huntington Ingalls also received different military-related awards. It is important to note that not every contract is directly linked to the Iran conflict, but a rising conflict environment makes defense spending politically easier and increases procurement momentum. That is why traditional arms makers, drone firms, secure communications providers, and battlefield software companies naturally rise to the top of the war winners list. The fourth category includes those high net worth individuals and billionaire-linked assets whose wealth is connected to sectors that become strategic during conflict. The first name that comes up here is Elon Musk, because SpaceX's Starlink has become a strategic communications backbone in conflict zones. However, I did not find an authoritative Reuters piece on this specific US-Iran war that directly confirms Starlink's battlefield role, so this should be said with caution. But the broader fact remains that satellite communications, launch surveillance, and dual-use technologies suddenly become critical infrastructure during wartime. In such a situation, the strategic relevance of those whose wealth is tied to these platforms increases, and in many cases, so does the valuation narrative around them. This is not direct cash accounting, but it is the economy of power and premium. Donald Trump's name has also appeared in some reports because parts of his wealth seem linked to crypto-related ventures and media exposure that can benefit from geopolitical volatility narratives. But caution is necessary here as well. It is not easy to draw a direct causal line between wealth estimates and conflict-driven gains. So the more accurate way to say it is that some ultra-rich individuals have wealth connected to sectors that suddenly become hot during conflict. Energy, defense, satellite communications, safe haven trades, commodities-linked vehicles, or volatility plays. In these kinds of conditions, their wealth can rise sharply with market moves. But that gain is not always linear or guaranteed. The fifth major group is traders. But not in the filmy sense, rather in a very technical sense. Not every trader makes money in a crisis. Many get burnt too. But for professional traders dealing in high volatility, commodity desks, options players, energy arbitrage specialists, and short sellers, extraordinary opportunities are created. Barron's reported that with the sharp jump in oil prices, short interest in the United States Oil Fund also rose to nearly 50%, and WTI saw a massive intraday swing of as much as $38 in a single day. This means volatility itself became an asset class. Some were long on the crude rally, some were short on the reversal, some were buying or selling options volatility, and some were taking bearish positions in fuel-sensitive stocks like airlines. A crisis does not just move the market up or down, it makes it violent. And professional money often makes its profit from that very violence. The angle of short sellers and macro funds is even more interesting. According to Financial Times reporting, short interest in Wizz Air rose because the Iran war, fuel costs, and regional exposure hurt its profits. That means investors who bet against fuel-sensitive airlines could potentially gain. But on the other side, the same volatility also proved deadly for hedge funds. The FT also reported that the macro fund Caxton Associates suffered losses of more than $600 million in the fallout of the Iran war. So it would be incomplete to simply call the trading class winners. The correct way to put it is that volatility creates opportunity for specialists, but only for those who have speed, hedging ability, and correct positioning. For everyone else, the same market can turn into a slaughterhouse. Inside this entire story, there is also a hidden beneficiary in shipping-related pricing power, even if it is not separately listed in your original categories. Reuters and market reporting showed that freight costs rose sharply, tanker routes were disrupted, insurance risk increased, and accessible cargoes began carrying a premium. When uncertainty rises at a choke point, it is not only the oil producer who earns, freight owners, insurers, rerouting service providers, and logistics middlemen can also increase their price. Yes, this gain is uneven, because some ships also get stuck, some cargoes get delayed, and physical risks remain very high. Still, crisis gives more power to the toll collectors of the supply chain, but it would be a dangerous oversimplification to leave this story at just who made silver. Because standing opposite every winner are many losers too. Energy importing countries, airlines, petrochemicals, transport operators, fuel-intensive manufacturers, and ordinary consumers. All of their pockets come under pressure. Reuters reported that central banks are monitoring the oil shock. The Australian central bank has even raised rates. And the dollar strengthened because investors ran towards safe haven assets. That means behind every war profiteering story runs another story as well of inflation, expensive transport, costlier airfares, weaker growth, and household stress. Gold is also part of this picture, even if it was not explicitly included in your original five category list. Reuters reported today that investors returned to gold while watching the Middle East fallout and prices rose again. This tells us that in a crisis, the scarcity is not only of oil, it is also of certainty. And when certainty becomes scarce, money runs toward commodities, the dollar, gold, and select strategic equities. In that sense, conflict creates less new wealth and reallocates more existing wealth. Money does not suddenly appear. It shifts into those pockets that look essential, protected, or strategic during fear. If the essence of this whole story has to be drawn out, it is deeply uncomfortable. In destruction like a US Iran war, the biggest gains are often not made where bullets are flying. They are made where the supply of scarce things exists. Alternate crude, refined fuel, weapon systems, satellite links, market liquidity, hedging tools, and volatility trading capacity. That is why safe zone oil exporters, refining hubs, defense contractors, strategic asset billionaires, and skilled traders appear to be the most visible financial beneficiaries of this crisis. But this silver is not a story of celebration. It is the story of that brutal capitalism in which war raises prices on one side, and those same higher prices turn into profit for certain pockets on the other. That is exactly why war headlines are not just about geopolitics. They are also about balance sheets. And perhaps the bitterest truth of this conflict is this. Where human beings are running in fear, the market is writing opportunity for someone else.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestion. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls, and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.